podcast where we put you on the map. This is Ron Costa, broadcasting live in Las Vegas. And today, boy, do we have an interesting show for you. We've been talking about all different forms of crowdfunding. And our last show, we talked about opportunity zones and how that really is the buzzword right now in the real estate world. It generated so much interest and so much questions. We're going to kind of take that to the next level today. And with that, let me introduce to you our guest today. We have Darin Mangum, the PPM Attorney. Darin, how you doing today?
Hey, how are you, Ron? Thanks for having me on.
Absolutely. Boy, you know, it's funny how I've been looking at you. I've been watching your videos and looking at your website, and you know, Darin Mangum, the PPM. I think that's great branding right there. That's genius branding, because everyone knows you as the PPM Attorney now, right?
Yeah, exactly right. Yeah, that's my nickname, right? It's my middle initial PPM, right?
Yes.
Yeah.
And you're working out of the beautiful state of Utah, where you see amazing things every day from your office window, right?
Yeah. Well, actually, today I'm actually calling you from we just opened an office in Puerto Rico, and so I was able to escape the winter blast, and so we opened an office in Puerto Rico just for tax reasons. But you know, a lot of people don't know that you know, pretty much most of the whole island of Puerto Rico has been designated as an opportunity zone, and so it's really and not just because of the hurricane last year, but it's certainly you know, there's a lot of economic revitalization areas in Puerto Rico that I mean, it's one of the biggest opportunity zones that's been designated, and obviously you can look up any map, opportunity zone map that's been designated by all the various states, but yeah, I'm speaking to you from an opportunity zone at the moment. So,
well, that's great. That's great. So you're seeing the same kind of, I guess, excitement, let's say, or interest that are in opportunity zones that we're seeing here in Vegas and really all over the country. Then, right? I mean,
absolutely.
Yeah. Okay. So that's just not a regional thing,
mm-hmm.
Right?
Exactly
well,
right.
okay,
Yeah, it's all over the country, and you can find opportunity zones pretty much in there. I mean, every state is designated. I mean, obviously there are certain states that have more impoverished areas, more lower income areas that need more revitalization, and so than others. But certainly, it's you know, every state's got them. So you know. Yeah.
All right. Well, like I said in the intro today, we've been doing a couple of shows on opportunity zones. It's getting a lot of interest in. So why don't we just start off with the top level here? Can you explain what the opportunity zone is and why it's attractive to investors and people who are looking to start funds?
Yeah, absolutely. I mean, obviously, opportunity zones has been enacted as part of the Tax Reform Act in 2017, and we're certainly now getting a lot of guidance from the IRS as far as you know, how they should be structured and so on and so forth. But you know, really, essentially, it's a way that you know, investments can be made in lower income areas where either they have a higher poverty rate or you know, higher where the income is lower than the national average. I mean, all the governors of the states and obviously like in territories like Puerto Rico have designated certain census tracts as being opportunity zones, and they've been submitted to the Treasury, and the Treasury has basically approved them. And so within those areas, private investors, either a private investor individually, or you could certainly, in our business, the PPM business, we of course, you know, for the past going on 20 years have helped, you know, private equity, private investment vehicles we put together to, you know, whether it's to develop, you know, redevelop hotels, redevelop, you know, real estate development. I mean, most of the time it is real estate development, but the opportunity zone rules are pretty broad. I mean, it could be really any kind of business. It doesn't have to be necessarily real estate related. But you know, in most cases it is. But it certainly can be just an operating business in an area that you know, is maybe a lower income area. But essentially, you know, if you the big incentive is for investors, what they're able to do is that they're able to invest their unrealized capital gains. So let's say they made a lot of money, a lot of capital gains. Let's say they bought and sold a lot of cryptocurrency. Let's say they bought and sold a lot of stocks lately, and they've got now this big capital gains bill that they're going to get. Within 180 days, they've got 180 days. They could take, instead of paying taxes on those capital gains, they could invest those proceeds into an opportunity zone, or put it into a fund, a private real estate investment fund, which we call an opportunity zone fund. They could put it into that fund, and then that fund obviously invested inside the opportunity zone, and they're able to defer those capital gains and potentially never pay if they hold on to it long enough. For example, if they hold on to it for longer than 10 years, they can certainly, any sort of income that they receive out of that opportunity zone could offset any sort of tax liability that they would incur. And in essence, they would wipe out any sort of tax liability whatsoever. And so it's a great incentive. It's every once in a while the government does get it right, whereas they can create incentives for investors to, invest in some of these impoverished areas to really build it up, which a lot of these areas need, and at the same time you're helping yourself, alleviate your tax bill. So that's really the big incentive that investors have, and so
it's like
go ahead.
It's like that old saying, I think it was Ronald Reagan, we're from the government and we're here to help you, right? It actually works this time.
Right. Yeah, it seems to be working, absolutely. Yeah.
What I like about it, too, is a lot of real estate people are familiar with 1031 exchanges, and this is kind of like a 1031 on steroids because it doesn't have any of the requirements of the 1031 as far as like-kind property. And as you mentioned before, it could be anything. It could be, selling your business. It could be maybe you sell a piece of art, anything that you're going to incur capital gains taxes on. And then when you mention the word investors, people look at that word and like, okay, well, I'm not an investor. I own a business or I work whatever. Anyone who generates the capital gains tax can take advantage of this program. Right.
Anybody, you don't have to be a professional investor. You could just, anybody. Let's say I had a laundromat and I sold the laundromat, or hey, let's say I just sold my mutual fund or whatever, and I've got now some capital gains. Well, shoot, I could take those and put it into an opportunity zone fund, and obviously, potentially defer it, and again, if the incentive is to hold on to it, the longer you hold on to it, the more the more attractive it is, and so, it's an immediate. You're able to, immediately defer those taxes. There is no upfront tax bill because you've invested it into an opportunity zone. So. It works pretty great.
Oh, well, let's look at it from a fund perspective. Let's say I wanted to start my own fund. I know you can self-certify these funds, so if I'm a real estate developer, I can just submit something to the IRS or whatever with a document saying, hey, I have the XYZ fund, and now I've got this fund going. So let's talk about that a little bit. That fund that's created, from a legal perspective, or from an SEC perspective, I guess, is that considered a security?
Absolutely. It's considered a security, but most of them are structured in a way, and what we do is our firm helps structure it in a way that they qualify for what we call exemptions from registration under, say, Regulation D, for example, that allows for the formation of private capital, and that way you don't have to register with the SEC. I mean, you do have to file a few forms, and obviously you have to put together a disclosure document for investors, and that's typically what's called a PPM, like we were talking about earlier, a PPM attorney. But the PPM is designed to protect you in case the investors go sideways on you, in case things, because obviously there's risk in any kind of investment, and so you want to provide full and fair disclosure to investors, and that's what the law requires, and so that's what the PPM is. But it's something that it what we call exempt securities that are offered through an exempt transaction, like a private placement. And there's obviously different ways to do that. We can talk about that all day long, but certainly, we structure it in a way that is where you're fully compliant, in the way it's offered,
All right, so one of the questions that we got from our last our podcast was something we referred to this Howey test and how that applies to these funds. Can you just go over that real quickly? Is that a test to determine whether or not something is a security or not? Is that right?
Yeah, I mean, obviously it's a test that that is applied especially when it comes to, say, when you're looking at, say, investment contracts. I mean, that's your classic investment contract test is basically, have you invested money with and are you relying upon a third party to produce a profit? I mean, essentially that is the test. I mean, you are whenever you have an expectation of profits based upon the efforts of another person, then obviously that's a security. Now, in these cases with opportunity zones, typically the Howey test does not come into effect because we know from the very beginning that it's a security because the way the IRS has designated the way the fund needs to be structured, it needs to be an equity interest in an entity that is invested in the opportunity zone. So, for example, I would buy, say, a partnership interest. I might buy an LLC interest. I might buy a share of stock in this fund, and then the fund turns around and deploys the money in the opportunity zone. And once there's profits generated, then obviously it comes back to the investors, right? So it's very clear that because the IRS doesn't require it to be an equity interest, based on securities laws, any sort of equity interest, whether it's a share of stock, whether it's a partnership interest or an LLC interest, what have you, or even if it could be an investment contract, certainly those are all securities. That's no question about it.
Right.
So, but again, right. It's like, well, the fact that it's a security, well, that just means, okay, well, we just, have to comply with the various exemptions that are available in order to offer if those investments to investors, right? If you are, say, a promoter, or let's say you're a developer and you'd like to develop a piece of real estate in an opportunity zone, well, you just would put together a special purpose vehicle, like an entity that would say, hey, we're gonna invest in this opportunity zone, and here's our PPM, and here's obviously the law firm helps us make sure we're compliant, essentially.
Right. So these developers, they can create an entity, a corporation or a partnership, I believe, or LLC, and that is the requirement for the fund, for the self-certifying. And then, of course, like we just talked about, they would go to you, for example. You would create their private placement memorandum, and now they have a document that they can use to raise funds. Now, what can they do with that document as far as approaching accredited and non-accredited investors? Can they market that document? Can they go online? Can they do webinars? How do they get the word out on that?
Yeah. So certainly, that's a great question. What a lot of it, there's a couple. The good news is recently the securities laws have been revamped, and so there's actually more. Ever since the Jobs Act came out a number of years ago, there's been more and more exemptions that are available to raise capital, and the ones that are used most often in the private equity space or the private placement space is either obviously it's under Regulation D, but it's Rule 506B as in boy or 506C as in Charlie. Those are the two exemptions that are utilized the most because they have the broad. There is no cap on the amount that you could raise. I know, there's been a lot of talk about crowdfunding. I mean, regulation crowdfunding is a great way to go, but the problem with